We all know people that have amassed serious wealth through investing. If only we knew the secret formula for getting rich. Well, I have great news for you. You can outperform well over 90% of the investing experts without knowing the first thing about the market. This low-cost method of investing has never once lost money over a 20-year stretch. It is the most surefire way to outpace inflation over multiple decades. I've helped many people begin investing over the years, and I've never once, not a single time, not had one of them say, "That's it? You don't have to do anything?" after getting the system in place. Wall Street tries to muddy the waters by overcomplicating investing to make sure that everyday people like you and me feel like we need help. In this video, we'll cover everything that you need to know to receive your fair share of the market's return while on autopilot. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please hammer fist that like button, subscribe if you haven't already, and feel free to drop a comment down below with anything that comes to mind. Let's grow. How to invest. You'll first need to open an account at an online broker to purchase shares of stocks or ETFs. This is a scary step for most people. The idea of opening an account and managing your own investments can feel overwhelming. It's not, I promise you. Once you get it set up and get in the flow, you will not believe how simple it is. My favorite online broker is E-Trade. I love how simple it is to use and the clean interface of it. But I do think that M1 Finance is the best platform for a long-term focused passive investor. It is the king of set it and forget it investing. And it will also rebalance your portfolio in real time as you add new contributions. It will buy to your target allocations to make sure that everything stays properly weighted without you ever having to make a purchasing decision. Most online reviews find Fidelity to be the best online broker. I personally can't stand the messy interface of Fidelity, but you may want to investigate it as an option. After you do your own research and find your online broker of choice, you simply have to open up an account with an email address. It's just like opening an account anywhere. It will ask a few questions, and just a heads up, you will have to provide your social security number too for tax reasons with the IRS. And after the account's created, we're ready for the next step. Account types. You will likely have an account already opened by default when you log into your online broker for the first time. This will be a taxable brokerage account. It's where any investor can invest any amount of money at any time. Think of it like a checking or a savings account that you have at your bank. In fact, it is literally exactly that from a tax perspective. As you are likely painfully aware of, your employer will hold a variety of taxes from each paycheck. The net amount probably goes into your checking or your savings by default. This net amount will never be taxed again, and it works the same at your online broker. If you were to take $1,000 from your checking account and transfer it over to your online broker, it would still never be taxed again. Now, when you invest that $1,000 into stocks or ETFs and it eventually grows to $1,500, you will owe taxes, but only on that $500 that you earned, not the initial $1,000. So it's just like having money in a high yield savings account. You only owe additional taxes on the interest paid. And investments are actually a little better than that because when they get gains, it's known as capital gains, and they're taxed at favorable tax rates compared to ordinary income or interest received. There are many account types that you can open within your online broker. The optimal order for investing your money is debatable, and it's beyond the scope of this video. But I do have to mention the Roth IRA. There is no reason that you should not prioritize investing in your Roth IRA versus your taxable account. And this is because the money that you invest in a Roth IRA is identical to the money that you invest in a taxable brokerage account. It's all taxed in the year that it was earned. But the Roth IRA grows tax-free forever. You will be able to withdraw it tax-free in retirement. Remember that $1,000 that we talked about earlier that grew into $1,500? If that were in a Roth, all $1,500 would be tax-free forever. The little known secret about Roth IRAs is that you do not have to wait until you're 59 and a half years old to pull the money out. You can withdraw your contributions that were made to the Roth IRA over the years as soon as the Roth IRA has been open and funded for 5 years. But like anything else, this isn't too good to be true. There are a few restrictions for Roth IRAs. You can only contribute earned income, so you must have a job and earn income in the year that you contribute. And the contribution limit for 2024 is $7,000, or it's $8,000 if you're 50 or older. Your MAGI, which is your modified adjusted gross income, must be under $146,000 if you file single, or under $230,000 if you're filing jointly, to be able to make contributions to your Roth IRA. If you're eligible, be sure to max out your contributions to your Roth IRA each year before adding some money to your taxable brokerage account. I'm beating this dead horse because most new people that are just beginning their investing journey, by default, will fund the account that was open with their online broker when they first logged in. Okay, we're moving on to the last step. I told you beating these Wall Street experts was going to be a breeze. The S&P 500. I've read over 25 books about investing so far in 2024 alone. This tells us two things. There's likely something wrong with me upstairs, and there is a ton to learn about the topic if you're interested. But I'll let you in on the real secret. You don't have to read a single book to outperform most of these people that do this full-time for a living on Wall Street. The greatest investor of all time, Warren Buffett, straight up says most of us should invest in a low-cost S&P 500 fund. And it is exactly how he has set up 90% of his wife's wealth when he's gone. And the other 10% isn't in some fancy investment. It's just in short-term treasuries to basically have some cash on hand. So what makes it so magical? The S&P 500 holds 500 of the largest companies in the US. New companies come and go all the time from the index. About 20 companies per year are dropped from the index, and 20 new companies take their place. The business world is unpredictable and ever-changing. And holding a low-cost S&P 500 fund takes all the guesswork out of it. You never have to worry about when to buy and sell a company. It does it all for you. There are a lot of ways to invest in a low-cost S&P 500 fund. I'm a bigger fan of ETFs and index funds, but the differences are fairly minor. My favorite ETFs for the S&P 500 are VOO, IVV, SPLG, and SPY. And my favorite index funds for the S&P 500 are the Vanguard, Schwab, and Fidelity ones. It's VFIAX, SWPPX, and FXAIX. I prefer to use VOO just for the quality name behind it and the high assets under management. We know these funds aren't going anywhere. If your broker does not allow fractional shares, like E-Trade for example, you have to buy in full shares, then you probably want to roll with one of the low-cost index funds. For example, let's say you had $400 that you wanted to get into the market. You couldn't buy a single share of VOO because it trades around $500 per share. So you might as well stick that $400 in one of the index funds to get every dollar working for you. Another thing to keep in mind is that these funds do all hold the same 500 companies. I've had a lot of people mention that SPLG gets a lot more bang for the buck than VOO. And after confirming with them, they did have access and took advantage of fractional shares, but they still thought that the attractive price would promote more future growth. It's just not how it works. For example, VOO has slightly outperformed SPLG in the past 10 years as far as total returns. As of this recording, net of fees, VOO is up 233% in that time, while SPLG is up 230.8%. And this is only due to little timing differences in the fund's management. Pick one and let the generational wealth building begin. Dollar cost averaging wins. You've created your account and you've picked out your favorite low-cost S&P 500 fund. Now what? Oh yeah, that's right. We need to create an investing plan. And dollar cost averaging is the way to go. Dollar cost averaging, commonly referred to as DCA, is simply the process of putting in a set amount of money each week or each month. It is no different than paying any of your other bills on a consistent basis. It takes the emotions out of investing, and it also removes the element of timing the market, which we are all terrible at. Nobody knows what the market will do and when it will do it. But we do know that if we consistently buy in, it has increased by just over 10% per year over the last 100 years. This means that your money doubles every 7 years on average. And you'll hear crazy stories about people saying how you would have lost money over a 5 or a 10 or sometimes even a 15-year stretch. These are cherry-picked time frames with the highest possible starting point from the market's high all the way down to the lowest of lows as the ending point. Dollar cost averaging from the beginning has never once, not one single time in history, lost money over a 20-year stretch. You'll end up buying the highs, you'll buy the lows, and you'll buy everything in between, all on autopilot. You don't believe me? We'll look at how amazing the performance has been in the next section. The results supported by a backtest. A lot of times I'll use my portfolio projector to show how great this would work with average performance. We'll plug in 10% for a base case and then 7% if it goes a little rougher, or 13% for a great run, and things like that. This time, I'm going to utilize Portfolio Visualizer to show how this single fund strategy has performed over a variety of time frames. Let's go. We're out on Portfolio Visualizer, my favorite site for running backtests. Now, what I'm going to do first is compare the total US stock market to the S&P 500, just to show you guys that they're basically the same thing. I was able to pull from 1977 through 2024. I'm saying we start with an initial amount of $5,000. We saved up $5,000 and we're going to contribute $200 per month during this duration. It's 47 years, so it's quite a few years. 47 years is a long time, but it's not too unrealistic to a long career. So a couple $100 a month, we could definitely do this scenario. We're going to the performance summary right away. So you can see here with the total US stock market, and I put VTI. This is actually just the total US stock market, just as an asset allocation. And this is large cap, but I put in quotes VU. And you can see here that the S&P 500 index does match this basically. So large cap, without selecting VU, large cap is your S&P 500 and total US stock market is your VTI. Starting with $5,000, just putting in $200 a month for 47 years, which is a long time, gets us to 4.32 million with VTI and 4.59 million for the S&P. So the S&P is a little better, but they're basically the same. Look at these time-weighted returns, right on par. Same with the money-weighted returns. The standard deviation, you want this to be lower, and this is expected because large cap is less volatile in general as a rule of thumb. So the standard deviation is better, it's lower. Best year's a little higher, worst year's a little better. I just had a feeling there's going to be some like VTI or die type comments, and they're basically the same thing. I wanted to show this before diving deeper into the data. As you can see, since 1977, which is as far as I could go back, all the way to 2024, you have mostly positive returns. You always have some bad years. Here's the .com. We all know about this one. That's pretty brutal. And tech was even worse than this. Your QQQ and XLK of the world. I think VGT was just being founded a few years later. They were way down here each year. And then you recover and you have another real bad one. That's the financial crisis. You recover. But you can see for the most part, you go up. Sometimes you go down. Taking a look at the trailing returns over your 3, 5, and 10-year stretches and the full stretch, the full 47 years gets you 11.3% for all of them. And the 10-year is around 12% for all of them. You know, large caps, the S&P 500 has been a little stronger in the past decade, actually quite a bit stronger. VU has been stronger in VTI, but the reversion to the mean will happen, and over time they're about the same. But you're looking at positive annual returns over long stretches of time. But let's dive a little deeper on a shorter stretch of time with an actual ETF ticker, and we're going to use SPY. Okay, we used the ticker SPY, which is the oldest S&P 500 ETF that they have. And I'm an ETF guy, so I had to use it. It does have a slightly higher expense ratio, but it's still 0.09. It's not bad. And we used the same starting balance of $5,000. Our ending balance putting $200 in per month. And it's a total of $73,000 over this duration that you've put of your own dollars in after the initial $5,000. And your time weighted return and money weighted return are both above 10%. Standard deviation's low at 15. That's always good. So we're here on the portfolio growth section. I just like to show this. So we start at 5,000 in December of 93. So basically the beginning of 94. And you can see we're putting our 200 a month and our balance goes up. It goes way up. We get up to 33,000. But then all of a sudden, when we tip up to 52K, we're still putting in our 200 a month and we're all the way down to 32,000. But the important thing is that you put in $200 each and every month. So you bought it here, you bought it here, you bought it here. And then when you buy it here, it'll slowly start to go up after that recession. So you're buying at every single point on this graph. But then, sure enough, we go from 84,000 back down to 43,000. So you just cut your money in half. But as we stated earlier, we are continuing to buy $200 even at these low points. It's not when the price gets back to it was that your total balance fixes itself. Since you're buying down here, as soon as the actual price is even again, your value is going to be somewhere up here because you bought all along the way. A lot of times people that cherry pick those durations say, aha, if you bought here 11 years later, you finally got back to where you were. That means you're pretty much rich because you were cost averaging in that entire time. You won't have any problem finding how the S&P 500 has never lost money in its history over a 20-year stretch with dollar cost averaging, but that's why. When you cherry pick the worst possible, technically that's when people get the most rich because during that 50% crash, you're getting double the shares for every dollar that you put into the market. If you used to buy it at $100 a share, you're now getting the same unit, one share of the ETF for $50. As you can see by the annual returns, we did get in that .com, which was gross, and the financial crisis, which was even worse. And then 22 hit us pretty hard as well. Even with all those collapses, slowly over the years, you have over $500,000 at the cost of 73K. So that's the power of just dollar cost averaging in and staying the course. And for our trailing returns, the full duration got us just over 10% returns per year. And then the last 10 years have been a little better. The last 5 years have gone bonkers. But the bottom line is you're making a lot of money. I'm begging you to just give this a shot if you're on the fence. I want you to get your fair share of the market's returns. Learn as you go. Most things that sound too good to be true end up being disastrous, but the investing game really is this simple. If you simply create an account and start dollar cost averaging into an S&P 500 or total market fund, you will amass serious wealth over the years. It's one of the few things in life that rewards us for working less hard and making fewer moves. You just set it up, sit back and chill, and watch your balance increase over the years without paying any fees to these so-called experts. There are more advanced topics that you can learn about investing, but just these few steps will get you started in the right direction, and then you can fill in the gaps as you go. It's time for the weekly shoutouts. We had 3 new channel members. A huge shout out to Sammy, Joseph, and Jeff. I appreciate the support, and a shout out to all you that have been here all along. I hope you're enjoying the badges, the emotes, the spreadsheets, and the comment priority. And as per usual, no sponsors, not much to promote. I do have an affiliate link for Seeking Alpha that you can use in the description below if you want to try Seeking Alpha Premium for free for 7 days. And then if you like what you see, you can get at least 20% off your first year. I love Seeking Alpha. It's awesome. I've used it forever, and I'd love for you to try it out as well. Okay, and you guys know I'm a bookworm. I've alluded to it a few times, but I've also recently got my Amazon storefront page up and running. So in the link below, you can browse through some of my favorite books. You buy them just as if you bought them on Amazon, and 0 extra cost to you, and it helps support the channel. So check them out. Here's a couple more videos if you're not bored by now and you still want to learn more about this stuff. I appreciate you watching this to the bitter end. You are one of the real ones. Thanks for watching, and I will see you here next Sunday. Peace.